It is such a pleasure to be with you right here on ET Now. This is the India Development Debate and straight on to a very pertinent topic. I'm Supriya Shrinate. The liquidity squeeze is for real. The acute cash crunch in the banking system triggered by the IL&FS crisis has taken a heavy toll on key industry verticals. The real estate sector, whose fortunes are closely linked with the NBFCs' financial health, has been the biggest casualty, while allied industries like steel and cement have also started getting the jitters. Worse is the case of the auto industry, which is staring at a muted sales growth in the coming months. Already it has been sluggish in the month of November. The extent of the damage can be gauged from the kind of discounts India's top car maker Maruti is doling out to cut inventory. And it's not just about industry. The slow growth in consumer demand is taking a toll on the government's balance sheet as well. GST collections dropped to less than 1 lakh crore rupees in November, raising concerns of a huge shortfall in the indirect tax kitty in the current fiscal. The signs are ominous. The government will have to act quickly to perk up consumer sentiment. On the other hand, the RBI has to shed its indifferent attitude and ensure that there is enough cash on the table. How do we make the growth engines hum again? That's exactly what we're discussing right here on the India Development Debate this evening. Thank you very much for joining us. I'm joined by an eminent panel right here. Ms. Shobana Kamineni, former President CII and Executive Vice Chairperson Apollo Hospital Enterprise, joins us here. Ashok Saigal, Chair Subgroup on Ease of Doing Business CII, National MSME Council and MD Frontier Technologies is here with us. Madan Sabnavis, Chief Economist, Care Ratings, Geetambar Anand, President CREDAI National, and of course Maithili Bhusnoor, Mata Consulting Editor right here on ET Now. So thank you all of you for being with us right here on the show this evening. And Maithili, if I may begin with you, I know the meeting is tomorrow. This isn't a board meeting. This is the MPC. But will the focus be beyond just rates? Will the focus be on liquidity and not on rates this time around? Because that is what the clamour is for. And the clamour is not just coming in from the government this time around. It's also coming in from industry, whether it's cement, whether it's auto, steel, real estate, you name it, and everybody is clamouring for a rate, for some kind of a liquidity boost.
Well, Supriya, the two cannot be really separated because interest rates ultimately are a function of liquidity. Of course, liquidity has very different aspects to it. There is a question of durable liquidity, transient liquidity, etc. So, the MPC will never be able to take a decision on interest rates completely divorced from liquidity. So, I am sure they will look at the issue of liquidity also, definitely while considering what kind of policy action on rates to take. But the fact is, at the end of the day, ever since the RBI has become an inflation targeter, the focus has been on keeping liquidity tight rather than easy or loose. So, I think that is an inevitable bias post its shift to a liquid inflation targeting regime. So, certainly they will be looking at liquidity and examining the demands from all the various sectors for greater liquidity. But ultimately in this, I think the Reserve Bank of India is a technical body to guide the MPC in to determine whether the liquidity is sufficient or not for a growing economy. So, I think there the MPC will have to take a call and decide what kind of action needs to be taken. But for now, I do think, at least as far as interest rates are concerned, it will be status quo.
Okay, fair point. It will be status quo as far as interest rates are concerned, but interest rates and liquidity is definitely linked, and which is why we are perhaps even raising that debate. But if I may quickly go across to Madan Sabnavis before I go across to the corporates in the show. And Mr. Sabnavis, this is happening just days before the RBI board meeting. That board meeting is on the 14th, and the agenda of that board meeting is very clear: liquidity boost for the NBFC sector. So liquidity crunch is perhaps going to be a big talking point. And I know it will be foolish for us to divorce liquidity from interest rates just now. I'm presuming when the MPC met yesterday and the meeting that went on till today, the focus will be on liquidity. The focus will be, because that seems to be the predominant narrative.
No, I would tend to think that liquidity will definitely be an important subject in the Monetary Policy Committee meeting. And we at Care Ratings are really expecting a 50 basis points cut in CRR. So we are saying it's a 50% probability of a cut in CRR. The reason being that earlier we felt that it was almost a certainty. But given the fact that the RBI has already announced open market operations for this particular month, so we think it's a fair chance now there could be a 50 basis points cut in CRR, because the way we distinguish between an OMO and CRR is that CRR actually infuses permanent liquidity as against OMO, which is durable liquidity, and a repo, which is just temporary liquidity. And given the fact that there has been pressure on easing liquidity, I think a CRR cut would definitely help a lot And in terms of interest rates, we are expecting no change in interest rates, but I think the stance is definitely going to change to neutral, because we had something called a tightening or being calibrated tightening last time, and now there's no reason for one to believe that inflation will go up. So therefore, there is reason for one to change the stance to neutral, giving the indication that cut in CRR could actually go along with a neutral stance, where I enlarge liquidity and also ensure that interest rates remain where they are. And in case the market so desires, interest rates would automatically adjust in the downward direction.
Okay, fair point. I'll come to all of that in just a bit, but Shobhana Kamaneni, if I will start with you. The disappointing rate of growth as far as Q2 is concerned should prompt the central bank to act on liquidity, because many people believe and many people fear that things could only worsen from here on. The Niti Aayog vice chairman was that, and I'll get into specific sectors and, you know, real estate and cement and steel and auto in just a bit, MSME particularly. But Rajiv Kumar was here on the show some days back, and he says the prospects of a weakened H2 are now very visible because growth will be hit on account of liquidity crunch. Is that a concern you share as well?
You know, I do, because, and I hear what, you know, the earlier speakers have said, very technical, absolutely, you know, on course. I do believe that the RBI is not going to really change this. They'll be very neutral. But we have to understand that the economy has really taken a backseat in this country now with this. RBI is in its shell. I think that more people are wondering what's going to happen on December 11th rather than on December 14th, the RBI. And this is what the situation is. So here we are in industry. We know what it is. Just to give you a fact, we at a recent meeting that we had among industrialists, we kind of tried to put a figure around what is owed by the government to business in India. And that figure, you know, is actually, it can range anywhere between 1 lakh crore to 3 lakh crores. Can you imagine if some of that is really, we take a handle on that, start paying what's due, with it will ease liquidity. We need to start moving on the NBFC issue. All these, you know, we need to start working on the economy to reduce liquidity, because it's a fact that businesses are hamstrung now for to be able to think about expansion, to be able to think about investments, and this is not good for a H2.
So definitely this isn't good for a H2. But let me go across to Geetambar Anand. And before I go across to auto, I think it's only fair that I talk about your sector, because that has really been at the receiving end of this liquidity crunch. And that's one of the reasons why we're doing this debate, is because sector after sector is going to be impacted by this liquidity crunch. And so the moot question is RBI going to lend a helping hand? Coming to that question in just a while from here, but you know, conversations with either cement or the steel industry and now real estate that you represent tell us that things aren't looking good. You have been hit first by demonetization. You've been at the receiving end, you know, of certain other policies as well. But numbers which will soon be official tell us that things are not looking good at all. In fact, construction grew by 7.8% in the second quarter. But given the overall impact that it has on economic activity, how big a constraint will liquidity really be? I mean, how do things look from here on? We don't have official data of cement production just yet. But I spoke to a whole host of cement companies, and they tell me that production is down because sales is muted.
So, you know, what I would like to say is that, like you just said, there have been disruptions because of GST and demonetization in the last 4 years. Number one, there's a huge opportunity for growth, which we shouldn't miss at any cost, and each sector can contribute very robustly to the growth. What has gone wrong is that because of these disruptions, you see, there was a cash flow issue in most businesses. It was not an issue of bankruptcy so much in MSMEs and also in many real estate businesses. I can speak for our sector. The RBI has disallowed restructuring of loans, and SMA 0, SMA 1, SMA 2, the February 13 circular, has unnecessarily created an atmosphere of oncoming NPAs, whereas actually it is not an indicator. If you cannot service, you're delayed in servicing your principal or interest repayment for even 1 day, it qualifies as an SMA 0, or 30 days it's an SMA 1. That is more of a cash flow issue because of disruption. It is not something that is indicating bankruptcy of an enterprise, be it an MSME or even a larger enterprise. Here was this disruption, and the RBI, they had allowed restructuring of loans and lending to MSMEs and to each and every power sector, steel sector, real estate sector, which they disallowed completely. So that means once financial closure is done with a bank where you borrowed from, the tenure is getting over, you have no option to go back and take a further time. So you are left with no other option but to go to an NBFC and borrow at a higher rate of interest. How impractical is that? Here is a growth story. Here is an opportunity for growth. All the RBI has to do is, the PSU banks are robust enough to lend to all sectors, but only if the RBI allows restructuring of debt. And considering that there has been disruption, I don't see why it's not being allowed. You know, across in the SMA 1 and SMA 2 was a concept from the United States, wherein it was actually, so this has to be, they have to rethink the entire process of NPAs, bankruptcy and cash flow issues, and also restructuring of debt.
No, I get your angst, and the angst is, I get your angst, and the angst is not just on account of HFCs or NBFCs being unable to lend, but what you really want is that the banks themselves should be allowed to restructure differently, and in this entire NPA war, perhaps the restructuring has become too stringent. But the question really is, as far as the MSME community is concerned, sir, and my question is to you, Mr. Ashok Saigal, how are things to your sector? Reports do suggest that the IL&FS fiasco and, of course, the NPA crackdown has been very telling as far as a credit squeeze for MSMEs are concerned. Are you finding, but of course there are the same number of people who say that the worst is over and things are a little better now. Is that indeed the case?
Well, I think first of all, I would agree with what Mr. Anand has said, that as far as MSMEs are concerned, it is perhaps more of a cash flow issue than a profitability issue. And the technicality of NPAs, because the 90-day period is over, when they are not getting paid on time from the larger units, who in turn are not getting paid, as Shobna ji said, from the government. So there's a sort of circular debt, to my mind, which is causing pain to the SME sector. However, on the other hand, we have seen the Prime Minister's recent announcement of sanction of loan in 59 minutes. And what we have learnt on the ground is that whereas the in-principle approval is being given within 59 minutes, the disbursement is not happening. And according to some of the data, as much as 90% of the loans sanctioned within 59 minutes have not reached the disbursal stage even after another 30 days. So it is a question of decision-making paralysis in the banks because they're being overly conservative, as you mentioned, because of IL&FS and other issues. And SMEs then in turn have to go back to NBFCs, who are facing their own funds crunch because of recent events. However, I think we are hopeful that some of the steps we have discussed with the MSME ministry, and they have promised to take up with the public sector banks, how to speed up the disbursement of loan sanction principle, and we see that that could be something that would ease the flow of funds to the SME sector. As far as interest rates are concerned, I think SME is being charged more. There is the promise of the Prime Minister that new loans will receive a 2% subsidy or subvention, and that should help ease the interest rate issue as far as SMEs are concerned.
No, I'll come to that in just a bit, sir. Give me a minute. But before I go back to Maithili and Madan Savnabis, Shobna Kamaneni, if I may pick your brains quickly. You know, cement and auto and all, I mean, cement and steel and real estate will give numbers, but high frequency indicators like auto sales, for instance, are important to assess the impact of liquidity. Now, majority of the car makers have witnessed subdued sales in November. Maruti Suzuki, Hyundai, Tata Motors have all reported a marginal decline. Do you believe it's on account of liquidity crunch, on account of lending that's not happening? Or there are other macro factors that are perhaps at play as well? I'm presuming liquidity will be a big constraint.
Actually, liquidity is quite a constraint. But you know, the good news is that that the two-wheeler sales have actually shown some amount of increase. So there is some buoyancy in the system. But the four-wheelers that really require the financing, that is an issue. For the two-wheelers, there was the impact of the insurance. But with regard to the four-wheelers, you're really seeing the impact of the NBFCs and you know, just the banks unable to give loans. And I must say that the banks do have money, because but what's happened is, again, they've retreated into their shell because of the situation today. What we're seeing is that you know, you want to just give, you want to be so cautious and give money only to where you think it's a sure shot bet. Economies do not grow. The kind of growth that we need in India today is an 8+. That's not going to come by the system being cautious. We need to unleash some of that. We need to be able to, you know, open up some of these, some of the constraints that have built into the system, especially for the fact that there's so much agricultural distress. We have to see that also, that, you know, there are farmers agitating their MSP, the pricing, all this, and it's an election year. So, you know, it's almost like a perfect storm, but again, there's opportunity. So we shouldn't, this is not the time for us to retreat.
No, absolutely. I mean, I couldn't disagree with any of what you said. And in fact, one of the things that I believe is that it's really a function of the government wanting some liquidity, the RBI being absolutely stringent, and perhaps the reality lies somewhere in between. But for now, the RBI has been very, very adamant. But Maithili, you know, this entire debate really boils down to the fact that the government and the RBI have been at loggerheads over various issues, but primarily on liquidity in the system. One would believe that perhaps the government is justified in wanting the banking regulator to do more to make funds available so that growth does not suffer. I mean, you know, you keep saying that at the end of the day, it all boils down to one simple fact, that the elected government of the day is answerable, accountable, and responsible to people. And if the government believes there needs to be more liquidity, should the RBI not pay heed?
Supriya, yes, the government is the body that is answerable to the people, particularly in a democracy. But liquidity is a technical issue. So how much liquidity is required? It is the RBI, which is a technical body, which is most competent to decide how much liquidity is required in order to ensure a certain level of growth. At the same time, it is true that ever since, as I said, the RBI shifted to inflation targeting, it has always tended to err on the side of caution. So while government wants much more liquidity so that lending takes place, remember, if you remember 2008, when the government really eased, the RBI also eased liquidity, and you had both a fiscal and a monetary stimulus. Today we are reaping this, you know, paying for our sins, as it were. So while the government would want a huge amount of liquidity so that lending becomes very easy and almost everybody can take loans, the RBI on its part wants liquidity to be a little tight. So I think that both of them should sit down together and come to an understanding, and RBI should be given the operational autonomy. The government can put forth its case saying growth requires easier liquidity, but then leave it to the RBI to assess how much of liquidity is required and what kind of instrument is required. Because Madan's statement that you need a CRR cut. Now CRR infuses a permanent amount of liquidity. Now is that warranted, or is it that NBFCs today have got into difficulties essentially because they borrowed short and lent long? And is this an adjustment that they need to make? In the past, NBFCs borrowing hugely from banks. NBFCs need to borrow from elsewhere other than banks. So this is something that I think both need to sit together, and the government needs to leave it to the RBI to assess what kind of liquidity infusion is required and on what basis, what tenure. I think that is where the two sides are not seeing eye to eye. RBI is an independent central bank only in the forms of operational autonomy. Government is answerable to the people, but growth and inflation both need to be kept in mind, and ultimately there is a trade-off, particularly in the short run.
Yeah. Right, absolutely, there is a trade-off, but the fact that Q2 numbers tell us, and you know, I will take the point of CRR being this preferred instrument in just a bit. So I'll just request both you and Madan Sabnewis and everybody else on the show to not refer to it right now, because I have a separate section on CRR and whether that's a permanent instrument, it should be used as a shock or an instrument right now. But the question, the point that you make about growth and inflation both being important, Madan Sabnewis, Q2 numbers tell us that private final consumption expenditure has increased by just 6.9% in the second quarter versus an increase of 8.6% that we saw in Q1. Now, this is ironically happening at a time when investment leg of the economy is growing. So consumption is coming down, private consumption, but it's the investment legs that's growing. How are you going to finally balance these things out? Is there a need to boost consumption? Because India's economic growth story has been a mainstay story of consumption, and we can't look away from that.
No, absolutely. I think if we're talking of future growth of 8%, it has to be accompanied by higher growth in consumption. Now, the problem which we have witnessed in the second quarter, and this is something which will probably persist also in the third quarter, is that consumption has been more or less tepid. The reason being that the rural growth story which we thought of or would be hypothesized would take place hasn't quite taken off. Now, for example, we all know that farm prices are ruling lower than MSP, which means that the farmers are not getting adequate income. If we're talking of the SME segment in the rural areas, they too are being, they have problems in terms of growth. So therefore, we don't see their incomes increasing. So what's really happened is that the rural story hasn't played off. Now, if you're looking at the urban story, the whole question is, are we creating enough jobs? Is employment really increasing? If I'm talking in terms of around 3.5–4% being the growth in organized employment, I don't think that's adequate to actually push up consumption. Because we should remember that while we are quite happy with the inflation being in the region of around 3.5%, but cumulatively over the last 4 years, it's something like 18 to 20%, which means that your consumption power has also gotten eroded, income's not increasing. So that's the reason why we have seen some bit of stagnation in consumption. So it's gone back to saying that it's the government which has to spend either consumption expenditure or investment. So when we are saying that investment has gone up, it's primarily on account of government investment. Now, with the fiscal issues coming up towards the end of the year, one is also a bit apprehensive about whether there may be certain cuts in discretionary expenditure, that is capital expenditure, which will again have its repercussions on investment. So I think the situation is fairly grim as of now. So while we can still talk of 7.4% for the entire year, it's definitely not going to be something like 8% for this year in any of the other 2 quarters also.
Okay, fair point, but let me just take this across to Geetam Anand. And shrinking farm income is one part of this debate. Inflation is muted, there's modest wage growth that's happening, and the domestic consumer suddenly seems to have tightened his belt as far as spending is concerned. Is that a true assessment? I mean, apart from the concerns that you have on RBI restructuring, which I'm going to discuss in more detail from now, but is that an assessment of the spending patterns that you're seeing? Are people far more cautious, far more conservative than they were? Data does seem to suggest so, but what's the situation on the ground?
So, Supriya, it's more of a perception when you read in the paper, you know, when my consumer, my home buyer reads in the paper that there is distress in the real estate industry, and, you know, figures are thrown at him, so much unsold stock, etc., etc. And so they become cautious and they become fence sitters. They would have gone and closed that transaction, but they'd rather wait now. So it's a vicious circle, you know. It's very simple, you know. If we miss this opportunity with this consumerism that is, you know, it's bursting in our country. If we miss this opportunity now, be it auto, real estate, whatever, I mean, FMCG, if this opportunity is missed, then it's not going to come back again in a hurry. The RBI may be at loggerheads with the government, and I agree with Shobna when she said that there is, you know, the PSUs are quite flush. PSU banks are flush with money. It's not really a critical issue there. All the RBI has to do, it may have its own issues with the government, but all the RBI has to do for the citizens of the country is to reboot industry, and it can be done very easily, very simply with these 2 things that I said. And if this is not done, the NBFCs now are no longer an option because their money is expensive, because like rightly somebody said, they are borrowing from the banks. So I would rather not go to an NBFC, I would go to a PSU to borrow. But my only limitation over there is, considering that there are complications and intricacies in my business, I cannot be sure of the tenure of my debt. So if I am not allowed a restructuring, then there is a risk in taking money from a PSU bank. I would rather go to an NBFC so that my entire tenure of my debt does not tarnish my image with the tag of an NPA. So it's unfortunate that I and many people like me in my industry have to go to NBFCs. We would be happier going to PSUs, but the RBI has to enable the PSU banks to lend by being more aggressive, not shying away from taking that call on a business which they feel will do well and generate employment. The real estate and construction sector employs 5 crore Indians, and take 5 people to a family, we are talking 25 crore people being affected by this sector. That's nearly 20% of our population. And if this is not rebooted, I mean, why waste this opportunity? There's job growth, there's GDP growth, everything that can become that can be seen coming from here after the agricultural sector. So, and there is demand in the sector. People are, it's documented, 10 crore houses required in the 7 metros, 4 crore houses required in the tier 3, tier 4 towns. Are we going to just ignore this demand? Are we going to let this opportunity go? I think it is now only solely up to the RBI to do something so that industry can again have access to capital through PSU lending more than the NBFC lending, and it will be business as usual again. And let me assure you, if this is done, then in the next quarter you will see results.
Okay, fair point. Just give me a minute there, because your grounds is that why should you go to NBFCs? Because, you know, it's a lending that you'd rather get done from the bank. But what is your take on this, Mr. Sehgal? I know a lifeline has been given to the MSME. There's an interest subvention given of about 2% odd. Are new loans easy to come by though? What is the experience on the ground telling you?
Well, yeah, I think experience on the ground is telling us that, as Shobhana ji mentioned, there is no certainty that banks have a shortage of liquidity. It is a paralysis of decision making, a paralysis of taking the risk, as Mr. Gitambar Anand has mentioned, that the banks have become too risk averse. Now, in this scenario, I really wonder, we are focusing on interest rates and liquidity being introduced by the RBI, but is that not something like pushing on a string? Where is the pull which is required? And it is that pull which has to come from consumer demand, which requires a certain amount of confidence in the future of the economy. So the steps which the RBI might take to infuse more liquidity, to reduce the interest rates, to my mind is not going to be sufficient. What is required is to create the demand on the other side, and the demand will come, and there is a demand for more investment, which to my mind, again, rather than consumer spending, if investment goes up, I think in the long term that is more beneficial for the country, and that is what needs to be unjammed and unblocked, and the funds must flow for new investment, and that in turn will eventually trickle down to consumer spending. But that is what will speed up the growth of the country and the economy, rather than merely focusing on numbers of what the RBI will decide at the push of the government or on its own.
Right. Now, I'm gonna move on to specific instruments of what the RBI can do. And Shobhana Kamlani, while I agree with Maithili that RBI is an autonomous central bank, should be given the authority to do so, but is the ability of the RBI to assess the liquidity situation in the economy under cloud because of the RBI's inability to read inflation right? I mean, RBI for quarter after quarter kept reading inflation wrong, and as a result, it did not cut rates when it easily could have, and which is why is its capacity to assess the liquidity condition right really being questioned today?
So, Supriya, I'm hearing all this, and I think that we're making it too onerous on the RBI. I don't think that the RBI is the single villain, or it's the single person that is the savior. So they're neither the savior nor the villain. I think that we're just kind of venting a lot on them. But there is a series of things that needs to be done by several. And if I, at the risk of sounding like a stuck record, I've come on your show very early. I think that almost for a year I've been talking that not that the government needs to let go. Why are we not selling some of the PSU shares? Why are we not easing the system there? What have we done with this series of smaller? Yes, we're hearing the big the IBC is coming to fruition on the big accounts, but what about the medium scale? There's so many of them that are stuck with banks on their balance sheet that they're provisioning. We need to start letting go of some of these. And the last thing, what I said again, that we need to create more, that the payments have to come from the PSUs, from the government, that all these are stuck in. I think that all this has created the logjam in the system. It's not just the one RBI and what they are doing. Of course, it's an important part in liquidity, but it's not the be-all and end-all there.
No, I understand where your angst is coming from, and the angst is really coming from the fact that there are many instruments that can be unleashed before RBI begins to do that. But Madan Sabnavis, you had spoken about the CRR, and I want to turn focus specifically on that before I take a breather here. And want to ask you the question that RBI is the best judge to assess liquidity constraints in the system. All of that said and done, but many people are saying there have been calls that RBI should cut the cash reserve ratio. Will that be productive though? Because that is a more structural tool. It will perhaps unleash permanent liquidity, unlike the OMOs that are perhaps a little more transient in character and nature.
No, absolutely, because actually if you look at CRR, I think ideologically one can say that when we have had BAL 1, BAL 2, BAL 3, we have an SLR which is already there, we have liquidity coverage ratio. Is there actually a requirement for us to have a cash reserve ratio? Because a CRR was conceptualized when we said that we need to have the solvency of the system, and we have seen that since independence the banking system has held up well. We've never had a case of failure, there's never been a run on any bank. In such a case, I think there's need for one to actually roll back CRR to a more modest level, given the fact that there is a cost of CRR where banks are actually borrowing at say 4%, paying savings deposit rate, and you're not earning anything on it. So while there are adjustments allowed when you're calculating your base rate, the fact remains that there is a positive carry when it comes to CRR. And given the fact that we have a liquidity problem right now, I think it makes a lot of sense that if I want to really usher in a large amount of liquidity, just think of 50 basis points, I have my NDTL of around 1.3, sorry, we can release maybe around 65,000 crores in case I cut by 50 basis points. That's a huge amount. Rather than going around with 10,000 crores of OMOs every week, I think 65,000 crores will be a big push, which should definitely assuage liquidity and bring down interest rates right away. So I think that would be the way to go.
Maitri, do you agree?
No, I really don't, Supriya. I don't disagree with Madan on this, for the simple reason that I said you are assuming that the liquidity shortage, the deficit is sort of a durable, long-term nature, and that I don't think is correct, because what we are seeing with NBFCs is a transient crunch that NBFCs have got themselves into. In fact, in this entire debate, if lending is a problem, there is an easier way which the government should have gone in for much earlier, which is recapitalize the banks. They could have issued recapitalization bonds, which really are not a big burden on the fisc. It is essentially a book entry with only the interest cost adding to the burden on the government's books. So this is something that has been done in the past as a tried and trusted tool. So I really do not know why government has been so shy of issuing recapitalization bonds. Had they done this right at the beginning of their tenure, things would have been very vastly different today. So I don't agree with Madan at all on the issue of CRR cut. The CRR cut would infuse liquidity on a much longer term basis at a time when we are not very sure that this entire liquidity would be used for productive purposes. And the shift in the economy away from consumption into investment is a desirable shift, because we are already near capacity utilization. So we do need to have investment. So I am very happy to see the shift. Consumption slowing down, investment picking up is a change that was overdue, and now it is happening. So we should in fact welcome this shift.
No, fair point indeed. And I think, yeah, on that note, we're going to take a quick breather. We always like disagreements and, divergent views on the channel. So on the CRR, two of the top people that I turn to for as the economic perspective disagree, and that keeps the debate going. We'll take a really quick breather, but we're back in just a moment, and we're going to talk about the other aspects of the Monetary Policy Committee meeting. that's going to end, and what the RBI could be doing as far as its stance is concerned, and will that bring in some solace as well? Give me a minute, I'm back in a moment. All right, good to be back with you once again on the India development debate. We're going to take this forward and talk about what else can the RBI be doing. I'll begin with you, Ms. Kamineni, and you know, there are deflationary trends that one is seeing in the agro-commodity space, and which is why rural prospects are still looking dim. Liquidity squeeze for NBFCs is the other big reason. Is there, however, you know, a semblance of the fact that the you know, the NBFC space is not one homogeneous space, so to say? There are, you know, there is a nuanced way to even look at that space, because there are NBFCs that are strong, they can access funds, and those that won't. Is there a greater need to also do that so that the debate doesn't get lost in, you know, the RBI versus the government sort of a thing?
I completely agree with you. They are they're materially important NBFCs that are almost the size of banks. Some of them are the size of banks. There are about 100 of them. So you know, but everything being clubbed into one and being called shadow banking, I think that this is a fundamental. So while we're, you know, out there and addressing all the issues, this is something that really needs to be looked at, that we have to see which are the fundamentally important ones, treat them almost like banks, get them back into the game, because this is they're important. They've established a legacy of doing good lending. And they have a large population base that they're actually working for, and this will unlock some liquidity. So I think one of the things is, you know, your question is absolutely correct, that we should look at things differently.
Geeta Anand, you agree, because the HFCs, the Housing Finance Corporations, are a lot better off than some of the other NBFCs, and yet, you know, when we talk about NBFCs and on back of the contagion from IL&FS, it was as if, you know, NBFCs is this one lending unit. The reality is that the issue of less money is different from one NBFC to the other.
Absolutely, absolutely, and very rightly said. Some NBFCs are actually functioning more or less like banks because they have a robust book, and they have been playing an important part in the growth story of many real estate companies, and they should be supported. This panic which has been created, you know, okay, I agree there were irregularities in some NBFCs, but it doesn't mean that you just stop business and just put everything on hold, and this has a ripple effect. It affects not only real estate but mostly also MSMEs who don't get money easily from PSUs. So like I said, there are NBFCs which are growing very well and they have a very bright future. Somebody said earlier in the show they should be allowed to borrow cheaper money so that there's a good healthy competition between them and banks in lending. And if that is done, because they very rightly said have to borrow from banks many often times, which is not fair. And if they are allowed to raise capital which is cheaper, there will be, it's better for industry, it's better for the economy, it's better for business. With a thrust on Make in India, I think capital has to be made available abundantly from various sources. Industry's perspective is that we should be allowed to raise ECBs, of course with hedging, and why not? Because there is a growth potential here, there's a huge demand like I said earlier. And if all this is not thought of very quickly, we'll miss the bus. And I must also say that we are not venting against the RBI. If our demand has been, you see, the two things we are asking for are within the purview of the RBI policy, which is re-looking at on requalifying the SMA1 and SMA2s, and also restructuring of debt. This is only within the purview of the RBI and not with the government. So therefore, that is why we are asking the RBI to do something about these two things, which can actually create, give a huge boost to all industries across.
You know, Right. You know, not related to this, but something that's going to affect your business, Mr. Saigal. And a quick question there. I know on the PCA, the BFS, there will be a technical committee of the RBI that's going to look into this demand of the PCA. But will it really make a difference if norms are indeed diluted and some of these banks and PCAs begin lending? Because the charges that MSME has been at the receiving end, because a lot of these banks that lent to us MSMEs are now in the prompt corrective action you know, space. They can take deposits right now, but they're not being able to lend. Will that make a material difference? It's unrelated, but very quickly, if I may get it out of the way.
I think let's not. I think no. I think first of all, let us debunk the myth that SMEs have cause more losses to banks than large industry. The facts are that the losses to the banks on account of non-performing assets, etc., is much higher from larger industry than SMEs, although the number of MSMEs involved may be much larger. So loans to MSMEs are not the reason that banks have to take PCAs. The cause may be more, and I think there is a request from all of us, and the RBI certainly can help in this, is that for MSMEs which are down the chain of payments, which are stuck with the government and then the larger enterprises and then come to the MSMEs, if the period of NPAs for MSMEs could be elongated beyond what it is in general terms, that itself would be a very big relief and would give a big boost to bank lending for MSMEs. I think that is one really important area where RBI can help get more momentum into the MSME sector.
No, absolutely. Just give me a minute now, because I want to go across to Maithili. And Maithili, you know, when we talk about liquidity, we just can't be talking about in the domestic context alone, because liquidity is drying up globally as well. How much of that is going to be a function in the decision making? Because tightness is creeping in. You know, Fed is going to hike interest rates by some assumptions 5 times in 5 months. The impact, many people believe, is already telling on Asia. It's only going to tighten the situation here. Is that a correct assessment? Do you agree?
Oh yes, certainly. In fact, global liquidity is slowly drying up, because not only is the Fed hiking rates, it's also reducing the size of its balance sheet. It's no longer buying as many bonds as before. So there is a global drying up of liquidity. So this is going to impact liquidity not only in India but all over the world, and that definitely is a factor, because we're going to see less capital inflows into the country. So there is a drying up of liquidity not only in India but globally as well. So it's important to understand that what we need is adequate liquidity for the right kind of business decisions. It's not a question of just flooding the world or India with liquidity. So this is a factor that we'll have to keep in mind, and this is going to impact growth as well as price of credit. So I think the RBI needs to take a very nuanced call, and which is why it is erring on the side of caution. So I think there's a very fine line that the RBI must tread in ensuring that it provides enough liquidity for the economy to grow. So what you really need to have is adequate liquidity and a near neutral rate of interest. Now, it's easy for us to say this, but to actually assess what is the right kind of liquidity, what is the right quantum of liquidity, is a very, very difficult exercise. And as we have seen, there are so many factors in the globe, in the world economy, that are constantly changing. Take a look at global oil prices. The way oil prices have been moving up and down, it's very difficult for any central bank to take the right call always. So there have been mistakes in the past, I would say. The RBI has erred on the side of caution, kept liquidity tighter than was warranted, and today as a result we are paying the price for that to some extent, because monetary policy always acts with a lag. But to argue that today we need a huge influx of liquidity would also not be correct. So I think both the government and the RBI need to find some middle ground. The RBI to ease up a little bit on liquidity, and the government to stop going on insisting that the RBI flood the system with liquidity. You have to find a common middle ground.
You know, but the question also is, and Madan Sabnavis, if I may quickly ask you this question, do we run the risk, like Maithili seems to be pointing out, of a system that's flush with too much lending? You know, a repeat of the heyday euphoria of 2008, 2009, where, you know, the lending was so euphoric because there was this sense of a business cycle that was picking up. Obviously, that's not going to happen, but in order to push consumption and all of that, do we run that risk? Because look where excessive lending has landed us.
No, exactly. In fact, I feel that what the RBI is doing is very prudent, and I would not agree with Maithili that they have been a bit too stiff when it comes to liquidity. I think one thing is for the central bank to ensure that liquidity is there, but commercial decisions need to be taken by banks. Now, just as what you have mentioned, that everybody is blaming the Reserve Bank and the banking system for saying that the lending conditions were very lax and we took too much of liberties at that particular point of time. And I have a fear that we may just be slipping into a similar kind of a syndrome today. Because today we are saying, I'm speaking as an economist now here, saying that, look, we need to help the MSMEs, we need to help infrastructure, we need to help power. So I have an IBC, I have a PCA system, which we have actually applauded when they were introduced. Now we want to dilute all these standards. So if it's not done with caution, I think we could be running the risk of running into another cycle of NPAs, maybe not today, maybe not tomorrow, but maybe after 4 or 5 years. So I think we need to distinguish between a commercial decision which has to be taken by the players and the regulator which sets the regulatory structure and allows you to play within it, providing liquidity where it's required, but the market should determine the interest rates, and I don't think it's the job of the RBI. You take up a certain call, you provide the liquidity. If the market feels that the rates of interest should come down, so will they go down. Otherwise, they should be where they are.
Okay. A quick last word to Shomita Kamineni. And ma'am, so much has changed between the last policy and this. I mean, oil is today at 62. It was at 85 the last time we spoke after policy, I remember. Rupees at 70. It was at 75. With fear of that actually going to 80. Inflation has undershot. Do you believe, forget about the rates, but as far as the stance is concerned, can that continue to be calibrated tightening, or does RBI really need to be more dovish? I mean, many people are actually questioning the RBI when it changed stance. Is December going to be too early to change the stance that it took in October?
You know, the oil prices did go down, but you see that they're hardening again. You see after the G20 meeting what's happening in international relations between China and the US. So you know, the world is not calibrating. So you cannot expect the RBI will go, you know, in the path that it's taken in the past. I don't expect them to do anything different. One thing is, and this is the last word, I do respect the independence of the RBI. I respect the competence, but I also think that we need to look at this more holistically, and we cannot afford to stop development at a time when India really needs those jobs. I've always said it, and I continue to say it. So if there's a last word, I think it should be about jobs. And the interesting thing is that we went through this entire debate and never raised the E word. So I think that is going to be the crux of whatever is going to take place over the next few months. Is going to hinge on what's happening with elections, whether it's liquidity, whether it's payments, whether it's the behavior of PSUs and unlocking and payments. All this is going to be a work in progress, which is again defined by what's happening with the elections. So that's my take on it. And industry, we've always been risk takers. We don't want a stable state. So we need to move. So we understand what the risks are. We just want to open up now and see where is it that we can play. H2 is in front of us. We're going to tackle it. It'll be tough, but I do think that we will continue, you know, the 7+ rate of growth.
Okay, 7+ rate of growth, but you're absolutely right when you say it's election and everything's going to hinge upon elections going forward. And I don't think it will be 2019 just yet. It will perhaps be the 11th December election results from the states, and much will manufacture from that. But thank you very much, all of you, for joining us on this edition of the India Development Debate. Ms. Kamineni, Mr. Saigal, Mr. Gitambar Anand, of course, Maithili Busnurmat and Madan Sabnagis. Thank you very much for participating in our discussion. The RBI, of course, will announce its monetary policy action tomorrow. Many people believe it will be status quo as far as interest rates are concerned, but the debate is not really around rates right now. The debate is around liquidity. The government of the day is an elected government, and the government believes there's a liquidity crunch in the system, something that's now beginning to tell as far as high-frequency data like auto numbers, cement, steel, real estate numbers are concerned. And one will have to expect RBI to lend a helping hand to growth, because growth is that rising tide that does lift all boats, whether it's jobs, whether it's economic activity. Everything hinges upon that, and the RBI will perhaps have to play its part as well. And if that means some amount of easing liquidity, so be it. Thank you very much for being with us on this edition of the India Development Debate.